welcome you to this Market Outlook webinar with Pure Financial Advisors Vice President and Chief Investment Officer Brian Perry and our Senior Investment Strategist and Financial Advisor Brian Fahey.
Let's dive on in here. Excited to talk. There's a lot going on in the world, and what we want to do is cover a few different things today. And we're going to start with looking at tariffs, right? A big topic in the last several months is tariffs. And we wanted to touch on the question of what are tariffs and why do we care? And as we dive through this, for those of you that maybe that were here on April 9th, some of what we talk about today may be a refresher or an evolution of where we were then, and some of it is going to be new as the world changes. So let's dive on in, and let me kick it over to the other Brian for some commentary on what exactly are tariffs. I think we all know the term, but maybe we don't know exactly what they are.
Tariffs have certainly been in the headlines for the last 3 or 4 months. There's a lot of different takes on it, but I think just starting with the basics is an important place to start. So very basic, a tariff is just a duty or a tax that's paid on imports as they enter the country. So if you're bringing in widgets from China, as soon as those widgets land in the port of Long Beach, you're going to get a bill from the Treasury and you got to pay that to get your goods. So the second question is really who's going to pay that bill? And there's really only 3 options. Either the firm that sent the goods from China or whoever is sending them is going to sell them at a lower price and take a lower profit margin. So just kind of adjust their price down to compensate for the extra price of the tariff. Or the importing firm, the US-based firm, can do the same. They can just lower their profit margin and sell it on to the consumer at the same price, but they're going to be less profitable as a business. The final option is the consumer can just pay a higher price. So tariffs aren't new, right? They've been around for a long, long time. And we do have some more recent experience with the tariff issues that we dealt with in 2018. Those have been studied pretty extensively by academics. And depending on the study that you're reading, you can come up with some pretty different conclusions depending on the exact tariff you're looking at and the exact product that you're looking at. So experience suggests that it really depends on what product you're talking about when you're trying to figure out who's going to ultimately pay the tariff. Some examples, it falls pretty heavily on the consumer. A good example of that would be washing machines back from 2018. There's other examples where the exporting country or the exporting firm just sold it at a lower price. If it's in an area where there's a lot of different options for the importing company to choose, then the exporting company is going to be a little bit more willing to lower their prices to compensate the buyer for the tariff. So the general answer is it depends. In aggregate, based on history and what we know, high tariffs generally cause higher rates of inflation, and that's going to slow economic activity. To the extent that that's true is going to vary, but that's the general gist through history. You get higher rates of inflation and generally slower rates of growth.
So how important are tariffs, or I guess more to the point, how important is trade to the United States? I notice a lot of stuff from Temu tends to show up at my house, but how important is a tariff, or how important is trade?
Yeah, that's a good question. So putting it in context, the US economy is about $30 trillion. Last year, we imported about $3.2 trillion. So, 10, 11% or so of what the US produces that goes into GDP is going to be from imports. What we have here is a list of all of our top 20 trading partners. Mexico obviously is at the top. Number 2 is China. So even though Mexico and Canada are part of NAFTA, that trading relationship is under a little bit of stress. It's a little bit more complicated there on how that's going to ultimately play out. That's a pretty big moving piece. The piece that's maybe a little more concerning for markets at the moment is what's going on with China, because we have pretty high tariffs, 145% on Chinese imports. And for US exports to China, that tariff rate's 125%. So that's kind of the main one that the market is focusing in on. And then when the reciprocal tariffs were announced on April 2nd, those announcements that tariff has been pushed back for 90 days. So in theory, there's negotiations going on with basically every country on this list to make the impact of tariffs smaller than was initially advertised. But in general, imports are super important. And I think it pays to kind of look at this in the global context, because the global economy is really built around the idea of goods being produced in its most efficient country. So think Taiwan is great at making semiconductors. Brazil, great at growing soybeans. Switzerland, great at making watches. So the supply chains for the global economy, especially for us, is very highly specialized. So we had a kind of a run on this during COVID. Think about during COVID when everybody wanted to buy a new car, but it was really hard to do it. There just wasn't enough supply. And during that time frame, I can remember seeing pictures of a lot of Ford cars just ready to be sold, but they were missing one little piece, the backup camera. And it's federal law, you can't sell a new car without a backup camera. So there's all these cars that were ready to be sold, but they couldn't be sold because they couldn't get the backup camera installed. So the impact of tariffs is really, really hard to predict because there's little pieces in a lot of the stuff that we buy that is going to be impacted by tariffs at a higher price. And how that's dealt with the economy, who's paying? Is it going to be the exporter? Is it going to be the importer? Is it going to be the end consumer? It's all up in the air.
One sort of as we look for positives in all of this is when I look at this list, and obviously geopolitical relationships are changing all the time, but at least based on recent history, most of the countries on here are ones that we have a relatively good relationship with at present. And I would say China would be the one where there's just been more strain over the last decade. And just to flash forward and just to point this out. This looks at goods imports by country, and the gray line is China. And you can see how from roughly 2006 through, until recently, it was the largest source of imports into the country. But it's really been declining since the first Trump administration, when the administration began putting tariffs on China. And then even that continued quite a bit and even accelerated under Biden. And so, one ray of sunshine is that imports from China have been declining as companies have sort of redone their supply chains, and that's a process that's been going on for 10 years. So even if it accelerates now, at least it's not a brand new phenomenon. It's more of a continuation or acceleration of something that's been happening.
That's a good point. I'd also add as another positive from COVID is companies really learned the value of having more diverse and robust supply chains. So rather than just importing a specific good or product from China, maybe it's good to have a backup in another country. So the term you might hear from business people is China plus one. So if something goes wrong in one supply chain, you can pivot and add those products from somewhere else. The other piece, and this kind of gets back to that chart that you were showing on China, is over time, cost of producing things in China has increased. China's had the one-child policy up until fairly recently, so their demographics aren't great. So labor costs have been rising in China, and companies have been pivoting out of China, moving to, Vietnam and India, Malaysia, Philippines, because they can get better labor costs in other countries. So it's not all negative for sure. The economy is going to develop over time. And it's not just tariffs. There's other economic reasons why you might want to think, if you're a business owner, hey, I don't want 100% of my supply chain based on getting this one widget from China. I should probably have a backup in case something happens.
Well, and at the end of the day, right, is that tariffs are also, at least the proposed tariffs, they're really a starting point or a negotiation or even a stick, if you will, where, hey, this is, and Trump has even said that these are the worst that they would be. And we've already seen signs, right, of some of these things being backed away or negotiated.
Yeah, so this is a good slide to kind of explain that idea. If we look at the green line, that's as of when we printed this slide, all the tariffs that have been announced to date. And already, as of the weekend after the weekend of April 2nd, that was wrong. Because that very first weekend, there was already carve-outs. So if you wanted to buy an iPhone, that was not going to be subject to tariffs. And then obviously, if you waited another week, the reciprocal tariff piece was kicked out in 90 days. And even as recently as yesterday, the 25% auto tariff was pushed back as well. So you're absolutely right, Brian, that the initial April 2nd tariffs have been pushed back, carved out. It's definitely a piece for negotiations. Those are ongoing. Hopefully some news will make it to the markets here in the next couple of weeks. But absolutely, that's a starting point, not a destination.
And
so,
oh, sorry, go ahead.
This chart, I think, is pretty interesting because we're looking at tariffs over a very, very long period of time. And one of the questions that I've gotten more than once from clients when they look at something like this or they hear the tariffs are back to where they were during the Great Depression is, well, that means we're going into a big recession. And it's probably not the right way to look at this chart. So I'll give you a little bit of economic history on this, kind of the too long to read version or the Reader's Digest version. If we're looking at this chart, notice how tariff rate dropped pretty significantly in the early part of the 1900s. So we had World War I, kicked off in 1914. And during that time frame, governments decided that, hey, it's hard enough having a world war. Why don't we lower tariffs so that we can get goods that we need into the country and help support the war effort and our allies? So tariffs came down pretty significantly through the First World War. In the 20s, they started going back on, but they really just came back on for US manufactured goods. At that time, the US manufacturing sector, for basically all of the 20s, absolutely did amazing. I think profit margins for US manufacturing expanded by like 50% in that decade. It's called the Roaring 20 for a reason. So you had Ford coming out with Model Ts, you had RCA with radios, you had General Electric making early versions of refrigerators. Things were going great if you were making anything manufactured in the US. And they were protected by tariffs. Granted, at the time, Europe didn't have a lot of industrial capacity because they were recovering from the war, but manufacturing was going great in the US during that time. But there's a part of the economy that did not benefit, and that was the agricultural side. So if you were a farmer and you went through this time frame, it was pretty hard. Initially, things were great for you because during the war, Europe wasn't able to feed itself. So the US had to send food to Europe. That meant that farmers were expanding production so they could help feed Europe. That meant that they bought on a lot of kind of marginally productive farmland. They had to buy new tools, more fertilizer, all those kinds of things to expand production. But what happened is European farms bounced back much faster than anticipated. So Americans were making all this extra food that didn't have real demand for it. So the prices had to fall, but farmers had all the debt from buying extra land, buying extra machines, and so on and so forth. So when we got towards the end of the 1920s, Hoover kind of tapped into this sentiment and told basically everybody, hey, we'll protect the agricultural sector just like we've protected the manufacturing sector. And that tariff that went on in the 30s is what people are looking at here, but it really wasn't the cause of the Great Depression. The Depression was already a year into it. I mean, they didn't know it at the time, but it already kicked off. So tariffs certainly didn't help the situation, but it wasn't what caused the Great Depression. And early, some level of tariffs here actually caused a really strong renaissance in US manufacturing. So there is a level that we're trying to find where tariffs might actually be supportive of US manufacturing and supportive of US manufacturing jobs. But finding that is a little bit of a struggle. We're going through that now. But to just wholesale say that tariffs don't work, you can find examples throughout history where that's just not true. You can find countries that have used tariffs as a way to protect their domestic industry, and it's been quite successful. South Korea is a great example. So we shouldn't view tariffs as 100%, they don't work ever, but we shouldn't also view them as an answer for everything because they're not. It's somewhere in the middle.
No, you bring up a great point that tariffs have been successful in a number of countries, including most of the great success stories of the post-World War II era, is that in a lot of cases, they built the economy on domestic manufacturing and trade with very high levels of tariff. You mentioned South Korea. There's a number of other Asian countries as well. The other thing is that at the end of the day—
Just one more comment on that last slide, Brian. When I was in grad school, I taught international economics. And if I would have said what I just said on this in the class I was teaching, like I would have had to give myself an F, because consensus for the economics world is tariffs should be zero. And every country should specialize in what they do best and import what they can't produce efficiently. In the real world, I don't know how well that actually works. There's somewhere in the middle that's probably the right answer. So it's not the dogmatic never tariff anything, and it's not the dogmatic tariff everything. It's somewhere in the middle. And we're trying to find what that point is.
Yeah, I think that's really well said. I want to shift to sort of what tariffs might mean for the economy and really what's going on with the economy. Before I do, just to highlight one additional slide and this was in the April 9th webinar, and we've used this in some other settings as well, is just a good reminder, I think, that if you were born in 1960, so if you're 65 years old, just think of some of the events that you've seen during your lifetime. And right now you're seeing some turmoil or whatnot around tariffs or potentially resetting the global economy. But it wasn't very long ago we had a global pandemic shut down the world. A third of the presidents we've had during that time period have either been shot or forced to resign from office. You had 18% mortgage rates, 0% savings rates, obviously 9/11. The list goes on. The end of the gold standard, and we'll talk about that a little bit more. The Cold War, where we were literally at the precipice of nuclear Armageddon. I always throw out the reminder that back in 1960, the Dow was at roughly 600, and today it's at roughly 40,000. And so, if you had laid out this list and said, hey, this is what you're going to face, I think most people would have put their money under the mattress. And it turns out financial markets did quite well, even against this backdrop. Just, a good reminder, I think, that there's always uncertainty. There's always exogenous events. But, at the end of the day, companies make things that people want. They get paid to do that. They make profits, and that creates a pretty strong upward momentum for financial markets. Speaking of the economy, there's a lot going on in this slide, Ryan, but maybe walk us through what really the takeaway is here.
Yeah, so what you're looking at here is all the pieces and parts that go into calculating what GDP is. So unfortunately, this still is slide because GDP numbers came out this morning. So I'll talk a little bit about that in a second. But what you really want to focus on here isn't so much the net export above or below the line or government spending or investment. What you really want to focus in on is the magenta color, kind of that T-Mobile color, because that represents consumer spending or personal spending. And that's the biggest driver of our economy. It's about 70% of the overall US economy is just what the Bryans spend on a day-to-day basis. That's not really slowing down. So this morning, GDP numbers came out below consensus. It was minus 0.3. The consensus was, I think, 0.2 or right around 0. It doesn't particularly matter. But if you strip out the import-export piece, and you strip out government spending, and you just focus in on personal spending, residential investment, and business investment, it actually came out at 2.3, which is the 20-year average. The 20-year average is 2.27. So we're right where we should be in terms of investment and personal spending. So the tariff piece is what screwed up the number this morning because a lot of businesses were front-running tariffs. So we imported a boatload of stuff in the last 3 months. Not a record amount, but about half of what we were doing right before or right as the market was recovering or the trade market was recovering from COVID. So this gray line, which is net exports, so imports lower your GDP. This piece isn't super insightful right now because we're not really sure what's going to happen. We know that we imported a bunch of stuff this quarter. That won't happen again next quarter, so that'll be a positive. But really what we need to focus in on is what are consumers doing, because that's 70% of the pie. So this is a piece, and just a preface here. There's two kinds of data that we look at in the market. There's soft data, which is sentiment survey data. It's what people feel or the vibes of the economy. And then there's hard data. The hard data is things you can actually measure. It's earnings, it's GDP, those kinds of things. This is the University of Michigan Consumer Sentiment Survey. It's been around for quite a while. I think it started in the late 60s. But if you were looking at this exclusively and not looking at anything else, you would think that we've been in a recession for the last 3 years. Because consumers have been really unhappy, probably more as a result of inflation. But anytime we have a reading as low as what we have now, we've been in recession. We had better readings on consumer sentiment at the worst of the financial crisis. So consumers are very sour on what the economy looks like, even though the real economy seems to be doing just fine. So the next slide really drives home that point. What you're looking at here is transaction data. This is from Bloomberg. So this is an aggregate of credit card and debit card sales transactions. So it's going to include kind of every credit card you can think of, all the big banks that are doing debit cards. Even though consumers have felt terrible about the economy for a number of years now, they're still spending. They're still spending pretty robustly. So even though we're seeing the kind of vibes-based economy look terrible, people are still opening up their wallet, they're still living their lives, and they're still acting like everything's fine. So when you hear different headlines, you see different data points, if it's on anything you can't touch, any kind of a opinion or sentiment, it just hasn't been an important data point for a number of years. What really matters and what's guided us through the last handful of years is things we can actually touch and measure. So just kind of an important point as you go through if you're reading financial stuff on your own, just keep in mind that sentiment data just really hasn't been a good indicator one way or the other for the last, call it 3 years or so.
No, and ultimately there will be a recession or an economic slowdown at some point. There have been in the last 60 years or 65 years, there have been 9 recessions. So basically once every handful of years. The last one was in 2020 with COVID. They're part of the natural economic cycle, and it's a scary word. And I think people hear that there's a recession and think that the world's coming to an end. And the pain is never evenly spread, right? Is that there's going to be a sector or a location that is more hard hit. You think back to the proverbial back in the 1970s or early 1980s with the manufacturing towns of the steel belt and stuff like that were particularly hard hit, right? Or maybe Silicon Valley in the early 2000s. But the reality is that for the average person, a recession is more psychological than anything else, even if it does occur. And again, this isn't a prediction that we'll have a recession anytime soon. We'll have one at some point. An average recession sees the economy decline between 1.5% and 2%. And I think when you just see the headline and the blaring of flashing news, the economy, shrank by X, it's easy to lose context on that. So let's look at what a 2% decline actually is, right? If you go out to eat twice a week, say you go to wherever twice a week, a 2% decrease in the amount of times you go out to eat is that you go out once less time every 6 months, right? So you go out to eat twice less every year, right? If you go on vacation or stay in hotels 20 days a year, 21 days a year for 3 weeks, you'd go away for one less day every 2 years. It means that one 4-day weekend would become a 3-day weekend every other year. Another way of looking at it, just on income, if you earn $100,000 a year and you get a 2% decline, you make $28 less a week, and that's before taxes, right? So I just think contextualizing it that, again, the economy, the GDP number this morning wasn't great, although like the other Brian said, there's some technical factors that went into that. Who knows what the economy holds, but even in a down economy, for many people, the impact's a lot more muted, and it's really more of a scary psychological thing than anything else. And again, it's not to diminish the impact on people that are truly affected, but I think it's important to contextualize what actually happens often. Catherine, let's just pause. We're going to shift to what all this means for financial markets and some strategies, but let's see if there's any questions on tariffs or the economy that makes sense to address now.
Do you recommend sitting on the sidelines until there's less uncertainty with all the volatility going on?
Yeah, I'll take that one, and the answer would be no, and for a couple of reasons. One is just I think that if you're going to wait for there not to be uncertainty, and this gets back to the slide of all the different events we've seen over time, you'd be on the sidelines for a pretty long time, right? Because there's always uncertainty. There's also study after study, and we can reference some when we get to the section on sort of how to navigate these times. Sitting on the sidelines subjects you to missing the good periods as well as the bad, and we don't need to look too much further than somebody that was on the sidelines the morning of our last webinar missed a 10% rally that afternoon, right? And so usually the best of times happen during the worst of times or the more difficult times, and that's what happens when you miss on the sidelines. So what makes more sense is to some of the things we'll talk about, make sure that your portfolio is properly allocated, make sure that you're taking an appropriate amount of risk, make sure that you're looking at various asset classes and the like. We can dive a little deeper on that.
And then you talked about recession, but it says with growth slowing for the first time since 2022, are we not in a recession, and should we be adjusting for the worst case?
Sure. So the kind of popular definition of a recession is 2 consecutive quarters of negative growth. Technically, we actually had that back in 22 until the second quarter got revised out, because we did have 2 consecutive quarters of negative growth initially. And then, when the data gets revised, the second quarter dropped away and was actually positive. So there's that piece. The other part is the numbers for this quarter, first quarter, were so wonky that you really can't take a clear reading of it. And that's why I brought up that kind of core GDP growth, the idea that you just ignore the import-export piece, ignore the government spending piece, and just focus in on what's really important, and that's the consumer spending. Those numbers look fine. Like I said, they're just spot on where we've been for the last 20 years. We're right in the middle of the road. So are we in a recession today? No. Will we be in a recession in 3 months? Probably not. But there is a heightened amount of uncertainty. So it's hard to say, but I would suggest that we'll make it through this okay, and avoid a recession. Might not feel like it for everybody the whole time, but I think we won't get that 2 consecutive quarters. If
Gotcha.
you're using that as your definite, there's other definitions, but we'll use that one for today.
All right. And how about what is the goal of these tariffs? What are the goals of the tariffs, and will it work?
Yeah, I think will it work is always an open question, right? I mean, who knows? The goal is to make trade more fair to the United States, right? I think that there's a perception, certainly among the administration and among a lot of people, that trade has benefited other countries more than the United States, right? Where we've seen, and all you need to do is look at our trade deficit every year, year after year after year. And I think some of that is placed on the fact that there's more trade protection or tariffs from other countries versus the United States, and it's to right size or fair size trade. And the concept is that that brings more jobs, more manufacturing, more value add back to the United States, which ultimately boosts the U.S. economy. So whether or not that works, who knows? I think that it's difficult. I think, like Brian Fahey said, there's probably a level of tariffs that do make sense to help right size that, and then it's just, do you manage to hit right on that correct level and implement it appropriately and stuff, and see the shaking out period without too much pain to get to the other side. And I think time will tell. Perfect. Yeah, let's dive back in with what's going on with financial markets. And let's look at the stock market maybe for starters. And this chart is declines in the S&P 500 since 2015. So you can see that the sharp one of COVID in 2020, where the stock market fell roughly 35–40% in a pretty quick period of time. You can see 2022, where the S&P 500 fell recently. And again, this is only updated through the about 3 weeks ago. You can see the drop in the S&P. But you can also see the drops in 2016 and 2018. And the reason I bring this up is twofold. One is that how many people out there even remember that the stock market fell in 2016 or in 2018 by double digits, or why it fell, right? So as you stretch out your time horizon, a lot of these moments that seem really important really start to diminish in their memorability. But the other is even something like 2020, which I think most people probably do remember. Let's flip the chart on its end and say these are the S&P 500 returns since 2015. It's been a pretty good 10-year run despite the hiccup in 2016, the hiccup in 2018, the COVID sell-off, 2022, and then again, a sell-off in the first quarter of this year. Despite all that, we've had a pretty good run. And so I think it just speaks to the fact that these declines are part and parcel of being an investor, but over time, they begin to diminish in impact, which is why we talk so much about, unless you have perfect foresight for when these are going to happen, staying the course generally makes sense. The other part of it is that market declines are quite normal. And this is a chart we show often where the gray bars are annual performance of the S&P 500, and the red is an inter-year decline. And what you see is that in most of the time, the market is up roughly 70% of the years. But in almost every year, you see the market falls peak to trough at some point pretty significantly. Again, just a reinforcement that volatility is part of the deal. The stock market increases roughly 53% of days, roughly 70% of years, but over time it becomes a great money-making mechanism. And so we think it's really important just to understand that as you invest in stock markets or any sort of growth asset, the reason you're getting paid the reason you're getting that growth is you're taking on risk, and that there is volatility to the downside as well as the upside.
Yeah, when I'm working with clients, I do like to remind my clients that you should expect a decline of, call it 10% any given year. That's why equities over the long haul will give you a better return than bonds, because you are getting paid by taking on that risk and that uncertainty. How much of that you want to take on, that's up to you and your financial plan and what you're trying to accomplish. We can't control the markets, but we absolutely control how much exposure you have to those markets. So that's why it's really important to work with an advisor and come up with a plan that makes sense for you and what you're trying to accomplish, so you're not taking on this volatility and the heartburn that comes along with it potentially for no good reason.
And then within the stock market too, we talk a lot about diversification, or how not all stocks are created equal. I've heard it said that we talk a lot about the stock market or the bond market, but it's really a market of stocks or a market of bonds. And I think that these next two charts do a good job of highlighting that, is that, if you look at the US and international stocks in 2024, and a lot of you might remember last year, the orange line is the S&P and the purple line is international stocks. International stocks basically flat on the year, while the S&P had a great year. So it's like, well, why don't you just own the S&P? Why would you ever invest in international stocks? And right around the time we were hearing that a lot, lo and behold, let's look at what happened. So this is year to date this year, that from the middle of January on, you can see that the international stocks, the purple line, are up more than 10%. And as of this printing, the S&P was down 7. So all of a sudden, you go from a roughly 20% outperformance for the S&P last year to roughly a 20% outperformance for international stocks this year. Again, with perfect timing, we would have been entirely invested in the S&P right up until, whatever this is, January 20th or something, and then flipped over to the international stocks, but that's really hard to do. But by having these different kinds of investments, you can take advantage of last year where you've got assets that are doing great in the S&P, and then this year, assets that are invested internationally that are doing quite well. Let's talk a little bit about, we talked about stocks. Let's talk a little bit about bonds and what's been going on with bonds, because there's been a little bit of volatility there as well. And maybe I'll kick it over to Brian to talk about this long-term chart of bonds and then what bonds have done more recently.
Yeah, so what Brian Perry is showing here is the yield on the 10-year Treasury, and constant maturity basis just means, what it was, if it was issued every day. 10-year Treasury is probably the most important financial instrument on planet Earth. You can see that there's a pretty long trend of declining yields, increasing prices for, call it, 40 years. That kind of ended in COVID, or at least appears to have ended. But having bonds in there is going to help have a ballast in the portfolio that when things go sideways, you can sell your bonds and buy your equities. So bonds do play an important role in the portfolio, even when they're not particularly exciting, or the very uncomfortable period that we've gone through post-COVID with inflation and bonds not performing very well at all. They still have an important role for everybody. But maybe in the next slide, Brian.
Yeah, and just before we flip to that, I think it's interesting too that a lot of people worry about rising interest rates, right? Because we went from basically, call it 1 or 2% to 4 or 5%. And it's like, oh no, and what if we go to 6 or 7? Does that spell the end of the world, right? And and then it's always popular to float back here and, oh, well, interest rates were at. But I think what's more relevant is if you look at the 1990s, and I think most people will remember that the 1990s were a pretty darn good period of time for the economy. We balanced the budget. The first dot-com boom was really underway. Unemployment was low. Times were good. The 10-year Treasury during that decade basically averaged between 5 and 7.5. So almost the top end of the range that we've seen here in the last couple of years was the bottom end of the range in the 1990s. And yet that didn't stop us from having a really awesome economy during that time period for the most part, right? And so just because interest rates move a little bit higher doesn't mean that the economy needs to suffer. And in some cases, having higher interest rates can actually help parts of the economy and certainly portfolios as far as generating interest or income. So let me clear that and then go to.
All right, so this is the dollar index since Nixon took us off the gold standard back in 1971, I believe. Gold has been in the headlines quite a bit because it's done really well. It is typically something people buy when uncertainty is elevated. And one of the popular things for people to drone on about is the end of the dollar. And as you can see over time, the dollar's been significantly lower than it is today, and it's been higher. So the average, if you were to take where the dollar was when we came off the gold standard versus where we were when we did this chart last week, the annual decline would have been a little bit less than 1/4%. So a lot of volatility in there, end of the dollar, end of the gold standard, inflation in the 70s and 80s. A lot of things happened, but at the end of the day, the dollar's just moved up, it's down, and it's not too far from where it started when we left the gold standard.
Yeah, I think that's a great point, right? Is you hear a lot of talk about a dollar collapse, and it's hard to argue that over the course of 50 years, an annualized 0.15% decline is a collapse. And the other thing is that there needs to be alternatives, right? And I don't know what other currency could possibly supplant the dollar at this point. Europe has its own issues, and it's the next biggest currency, but it's maybe 1/3 as popular as the dollar, and that's probably being generous depending on what metric you look at. The Swiss franc, the Japanese yen, the British pound, none of them are big enough. China's got a large economy, but you can't even freely trade their currency, so that can't take the place. And and then you hear talk about like the BRIC currency or something, and I don't know what I mean, you can talk all we want about the problems that the U.S. has, but if you're investing in potentially a currency backed by in part Iran and Russia, who aren't even part of the international economy, as well as countries like Ethiopia that are some of the more impoverished in the world, not to mention Brazil that has its own host of economic issues. It's hard to argue that that's more stable than the dollar. And so, while the dollar could certainly weaken on a cyclical basis, and in some ways that wouldn't even be a bad thing, I think the idea of the dollar going away or no longer being the world's reserve currency over any kind of intermediate time frame is, in my view, probably a non-starter.
Yeah, probably can't happen. The dollar's built into contracts. There's people that are trading, Brazilian soybeans and importing it to, Europe, and they're doing it in dollars. So it is still the benchmark for global trade. It's still where foreign reserve currency managers are parking their reserves because it's an important currency. And to Brian's point, there is no real alternative. Maybe there will be someday, but there's not today, and there probably won't be one in my lifetime.
Let's look at some potential strategies during these uncertain times, and then we'll answer some more questions. I guess, and we'll go through this. There's a bunch of things, right? But I guess to summarize, a lot of times the best thing to do when times are uncertain or you're feeling some sort of emotional strain is nothing, right? And there's all kinds of different ways to look at that, but this is just one survey that says that basically 2/3 of investors regret decisions they made due to emotion. And this gets back to the financial planning, right? And having that game plan in place that lays out what you're trying to accomplish and how you're going to accomplish it. And hopefully you compose that at a time of relative calm so that when things get a little bit volatile, you can refer back to that. And then from there, it's like, well, why don't you want to time the market? And I know that we've shared this recently, and I won't hammer on every number, but this is $10,000 invested in the S&P 500 over a 20-year horizon. And the numbers, this is through 2022. The numbers would be very similar if we ran it through this year. The reason I didn't is because I like what's on the bottom here, which I'll show you in a second on this slide. You can see that $10,000 in those 20 years turned into 65 grand if you were invested. If you missed the 10 best days, one day every other year, your money gets cut in half. You'd only have 30,000. If you missed 3 days a year, so you missed the 60 best days, instead of turning 10,000 into 65, you turn 10,000 into 4,000, right? So that's the difference between a successful retirement and living on ramen noodles. And the problem is that the 10 best days mostly occurred in the Great Financial Crisis or COVID, right? During the times people that were emotionally reacting were most likely to not be invested. And we have an even more recent example of this. These days have all been supplanted by one of the best days was the day that we did the webinar on April 9th, where you saw the stock market rally tremendously. That was one of the best days in market history during, again, a time of extreme volatility. And so just speaking to the cost of timing the market is that it's one thing to get out, but knowing when to get back in and not missing out on those big days is very, very tough. Which is why we talk so much about assessing your current portfolio and making sure that you have an appropriate mix of stocks and bonds. And Brian, maybe you can comment on making sure that you have an appropriate asset allocation as we refer to it.
Yeah, I mean, what you're trying to accomplish in your financial plan is really should kind of be the North Star of what you're trying to get done. Because like I said earlier, we can't control the market. You can't time the market. You can only control your exposure to the market. So if you know what you're trying to accomplish over a longer period of time, you can build a portfolio that's going to be robust and one that's going to get you to your goals and that you can live with. So that when we do go through periods like what we're going through now, you're still able to sleep at night. And staying in the market through time and through these issues that we have to deal with periodically is what's going to make you a successful investor versus not being successful. Like Brian just said a couple of minutes ago, staying in for those periods of extreme stress can be the difference between being successful and not. And like Brian said, eating ramen noodles. So the best place to get started is to have an allocation that you believe that we could work with you to build up that's going to get you to what you need to accomplish. And it doesn't necessarily need to be a static thing. You can maybe you're a little bit more aggressive when you're younger, and then as you get closer to retirement, it becomes more conservative. But having that allocation that's going to let you sleep at night and get you to where you need to be is really the goal. It's the whole secret sauce to investing.
Right. It's funny how the secret sauce is so often time tested, right? Once you get that allocation, one of the keys is to rebalance. This is something we focus on a lot at Pure. But at the end of the day, coming up with that appropriate initial allocation is really, really important. But if you set out on a journey and you never course correct along the way, you're probably not going to wind up where you want to go. So in this example, looks at what if you had $50,000 worth of stocks and $50,000 worth of bonds initially. Well, over time, and this is pretty close to historical averages, right? Is that maybe the stocks get you 10% and the bonds get you 5%, right? These aren't forecasts. This is just to make the math easy. Well, what happens is that the first year, as you can see down below, you have 50,000 in stocks and 50,000 in bonds, which was what you set out to do. A couple years later, you're at 60,000 in stocks and 55,000 in bonds. And as time goes on, those ratios shift so that after 10 years, you could see you have a lot more stocks than you do bonds. 20 years later, you essentially have 3 times as many stocks as bonds if you haven't rebalanced, right? And so all of a sudden, you're at a portfolio that is roughly 75% stock exposure when your goal was 50% stock exposure. Now, if that's intentional and you wanted more stocks, that's great. But in a lot of cases, this might have happened without intention. And well, if this stock portfolio has been doing good, maybe it's at a time where stocks are relatively expensive. Rebalancing forces that discipline of selling high and buying low while also maintaining your appropriate risk mix over time. And let's touch a little more maybe on the bonds, right? Because we hear a lot about bonds didn't have a great period coming out of COVID and stuff. And, the returns have been a little bit better lately. They've done what they're supposed to for the most part. This chart, I think, is interesting because it shows that during recession, stock and bond performance, and you can see that the blue is bonds. And so essentially in every recession we've had since 1980, bonds have posted positive returns. And so again, bonds are not the exciting part of your portfolio. They're very much the tortoise, not the hare. But the reason you own them is for diversification and for a source of stability during volatile times. And we've even seen that post-election, right? And Brian, do you want to talk about how Treasuries and stocks have done since the election? And obviously these numbers have maybe moved even since we printed this, but.
Yeah. I think it's also kind of important to call out the idea that after the election, the business community, the analyst community, everybody was pretty excited about U.S. equities. And that was the consensus trade, was you just buy American exceptionalism, there's going to be tax cuts, there's going to be deregulation, it's just stocks are going to the moon. Now here we are, and U.S. Treasury index is outperforming the S&P 500 on a total return basis through 24. So it's still true, but that gap isn't quite as big as it was back then. But you're right, Brian. It's the tortoise versus the hare scenario. So if you're doing this, you have an allocation that has fixed income and equities, and you combine it with what Brian brought up with rebalancing, your portfolio got pretty out of whack there in April. You had dry powder essentially with fixed income. If you were so inclined, you could have sold your bonds and bought equities at some point over the last month and had a pretty healthy return. Now you're going to probably be doing the opposite. If you're adding to equities over the course of April, now you're probably buying fixed income. But that's what bonds are supposed to do. And the other piece is that consensus trade can change pretty quickly. We're 4 months into it, and now instead of American exceptionalism, people are saying it's the end of American exceptionalism, and that'll swing back and forth over time. But the other piece is don't buy into the market narrative too far. Markets do trade on narratives, I think, but probably important to realize that you don't want to believe everything 100%.
That could be arguably the most important takeaway of this whole presentation, right? Is that markets trade off of news, and news is usually, I don't know, a lot of times it's like, don't let facts get in the way of a good story, right? And we talk about whatever, the dollar and the reasons why it's here to stay. But if the dollar falls 4 or 5%, you'll see stories about the end of the dollar, right? And
yeah, and
headlines.
Along those lines, Brian, when there was a hiccup in Treasuries in April, and arguably that's why Trump backed off on reciprocal tariffs. But at the time, people were searching for an answer for why Treasury yields spiked overnight. And a lot of things were thrown out, but one of the things that kind of got a lot of press was the idea that the Chinese were selling their Treasury holdings, which is flat out couldn't be true for 2 reasons. One, China doesn't own a lot of long-dated treasuries, and it was the long-dated treasuries that spiked in yield. It was the 20 and the 30-year. That's not what the Chinese own. They typically own things less than 7 years, particularly less than 5. And then when we actually got the data from, it's called the Tick report later in the month, China was actually adding to their treasury exposure. So the market narrative was, look out, the end of the dollar, China's going to sell all their treasuries, and it's the end of the world. The reality was the opposite was happening. And the market headline couldn't have been true because China can't sell things they don't own. They don't want to take 20-year interest rate risk on the US government. They don't want to do it in 30 years. So it was a narrative that was popular, got some press attention, and I'm sure it was, floating around social media, but the facts never lined up for that.
Let's talk just a little bit about a couple more potential strategies, and then we'll open it up for Catherine and questions. As many of you know, we're extremely tax focused over here, and the reality is that the market is completely beyond anybody's control, whether it's yours, mine, any investor. Market's going to do what it's going to do, and you build a portfolio designed to get reasonable returns over time, and generally that works out with volatility along the way. But from a tax perspective, there are things that you can do in order to manage taxes during volatile times. And one of them is in non-retirement accounts is to tax manage that by potentially tax loss harvesting. And so the idea is that markets go up over time, right? But that there's with volatility. And when you get these declines, you potentially sell assets that you then harvest those losses to offset future gains. And so there was a 4 or 5 day period back in earlier last month where we did tax loss harvest trades that amounted to roughly a quarter or 30% of the total assets in non-retirement accounts that we manage, right? And so again, we'd rather just see the market go straight up. It's a heck of a lot more fun, right? But when these volatile periods hit, you can be tax sensitive and generate positives that offset some of the volatility. Similarly, Roth conversions, right? The idea of having money in different types of accounts, non-retirement, pre-tax IRAs, and then Roth IRAs or 401ks. Well, a good way to get money into them is by doing Roth conversions. If the market falls 10% or 20% or whatever the number is, you can do a conversion and you're converting the same number of shares, but you're converting less of a dollar amount. That means less of a tax hit. It also means that when the market eventually snaps back, that snapback, that growth occurs in the Roth account where you never pay taxes on it. So by being thoughtful and rushing or moving forward potentially Roth conversions during a down market can help you be more tax efficient down the road, and maybe you even do bigger conversions in a year where the market's volatile, right? And so I think that taking advantage of some of the volatility to put tax strategies in place can make sense. The other thing, and just from an investment perspective, a couple of strategies is one is a lot of times the best advice is don't do anything, right? Just kind of stay the course. But if you're going to change your asset allocation, do it modestly, right? So with institutions generally do asset allocation, they set it, and if they're going to make a change, they do it by 1% or by a small amount. They're not doing it wholesale. So a lot of times we see individuals potentially make large changes. Generally, that doesn't make sense. So be subtle in any changes. And then consider different investment mixes, right? There are non-correlated investments, alternative investments that for some, they don't make sense for everybody. For a long time, they were only for institutions or ultra high net worth individuals. But over time, some of those structures have become available to more ordinary people. And they don't make sense in every case, but in some cases, adding some of these non-traditional, non-correlated assets can make sense. They can dampen some of the volatility and provide additional return streams. And in some cases, individual securities can even make sense, right? Individual stocks or individual bonds. Again, ETFs and mutual funds are great and we use them, but with individual securities, sometimes they can provide more certainty around what you own or your cash flows can make sense as well. So again, there are things you can do. Seldom should it be a wholesale change, but considering subtle changes to your allocation, the types of securities you own, or adding additional asset classes can at times make sense during periods of volatility. With that, we're going to pause and take whatever questions Catherine has time to field.
Okay, this one, you started to kind of answer this, but I want you to potentially go back into a little bit more detail. Are fund managers adjusting their investments to shift to stocks that are less susceptible to the tariff risks?
Sure. Why don't we let Brian Fahey take that one?
I guess I'm not clear on the question. You mean within the greater universe of people that invest money?
Well, I guess they're asking what adjustments are you are there stocks where they're saying, oh, these are not having any effects of the tariffs, so we're going to move over to this section? I think they're asking if there are sectors that are
I mean,
less susceptible
yeah,
to tariff risk.
in general, at least so far, the areas of the market that have done best are more value oriented sectors. So part of that is just growth equities have had a really good run for the last couple of years, so they're priced pretty expensively. So when that happens and growth expectations fall at the same time, dollars tend to move from the Nvidia, Microsoft, Googles of the world and into the JP Morgans and Berkshire Hathaways of the world. So the market's naturally doing that. One of the kind of more interesting things that's going on right now is US investors are absolutely buying the dip, right? Just that they've been conditioned that every time the market goes down, you just want to add to it because the market's going to pop back real quick, which can't be, that's been accurate for the last 15 years. What's interesting is Europeans specifically are selling US equities and moving back home. And if you look at the holdings data over longer periods of time, Europeans were holding, well, foreign investors, I should say specifically, were holding a pretty large piece of the overall market, I think around 30%, which is pretty close to where it was back in 2000. That's an area where it does look like investors are voting with their feet, moving out of the US, moving back to Europe. But if the question is just generally what do you want to own during a period of volatility and uncertainty and whatever tariffs might be, right now, it's more towards the value side of the world. We didn't really touch on this slide during the presentation, but about half of tech sector revenue comes from overseas. So if there is any kind of blowback from tariffs and our companies have less access to foreign markets, it's going to be felt more acutely in the tech sector. That's the area of the US economy that is most vulnerable. It's also the area of the US economy that's been most successful and a big reason why the US has outperformed the rest of the world for the last, call it 10, 15 years. So overall, just a more balanced allocation, especially given that, the last couple of years, all you had to do was buy tech and you did very, very well. Moving forward, you probably want a more diversified portfolio because the range of possible outcomes, how this tariff issue gets solved is not very clear. And it's going to be really hard to predict the areas of the economy that outperform, the stocks that outperform over the next couple of years when we have so much uncertainty. So spreading your bets makes the most sense.
Great.
Just to piggyback on that just a little bit, and I'm going to stop sharing. So sometimes it seems obvious, like, hey, that if ABC happens, that this outcome will do the best. But there are numerous instances in the financial markets of you could read tomorrow's news today and invest accordingly and be wrong, right? And so just knowing what's going to happen, like, hey, because of tariffs, ABC sector is going to do good, doesn't necessarily lead to good outcomes. And I think it's interesting that for only the second time since they've been assigning sector weights or choosing sectors, Charles Schwab stopped publishing views on different sectors in the last month. The first time they did that was at the inception of COVID, and then they just did it again where they were like, you know what, given some of the uncertainty and some of the volatility, we don't think it makes sense to try and call what sectors are going to win or lose here in the near term. So I think that speaks to the uncertainty out there, and also the fact that just because, hey, there's going to be tariffs or maybe the higher inflation, slower economy, whatever it is, doesn't necessarily tell you exactly what's going to do best, which why, to Brian's point, that diversification with maybe a slight lean towards value and defensiveness probably makes sense.
Very good. Okay, so we're getting close to the end of time, but long-term outlook is fine. But how should those in retirement adjust for their investments that they have in their retirement accounts now?
Yeah, I mean, I think it depends on what, again, this gets back to financial planning, right? Is there are people in retirement that are really at this point have enough money to fund their own retirements and they're investing for the next generation. So that's obviously different. If you're drawing from your portfolio and you need the funds, there should be a portion of it in relatively safe assets, right? And so if you look at it and let's say, whatever, you needed $50,000 a year from your portfolio, and let's say you had a $1 million portfolio and it was half in bonds, well, you've got $500,000 in bonds, which means that for the next 10 years, in a worst case scenario, you could be drawing down high quality assets without touching the stocks, right? Without to fund your lifestyle. I don't know. I mean, I don't know what the next decade holds, but there'll be multiple political regimes, multiple market cycles, and stocks will probably be higher at that point. So it's looking at, do you have an appropriate level of safe assets to tide you through any potential period of volatility? I think is a good starting point to solving that.
Excellent. And then, of course, this is one question. Do you have any idea, or can you expand upon the fact that USI bonds are limited to only $10,000 per person?
No.
It's a good esoteric question. I have no idea.
Yeah.
It was asked a couple times, so that's why I just.
There are tips. You can buy Treasury inflation protected securities in unlimited amounts, but the I bonds have that limit, and it is what it is.
Okay, and you did touch on Roth. We had a bunch of Roth questions, but Roth conversions now, better to pay taxes up front rather than later, and talking about this time period being a good time to do so.
Yeah, I think absolutely. This is a good time period. I mean, I don't know exactly who's asking the question, so everybody's particulars are going to be different. But I think tax diversification makes sense for everybody. Part of that can involve Roth conversions, again, depending on your situation. And so, yeah, taking a look and saying, A, do Roth conversions make sense? And then if so, do they make sense now? Absolutely. In a lot of cases, accelerating them can make sense given the market sell-off. It's just a matter of how much do you do, when do you do it, and stuff like that. And the other part of it is obviously markets have started to recover. So I think a lot of people, when they look at their portfolios these days, are surprised that maybe they're not. If it's a diversified portfolio, it's actually not down in a lot of cases that much, despite, if you just look at the news and then look at your portfolio, reality might be a little bit better than what the news would lead you to believe.
Right. And then one last, this person says that they're 3 years from retirement and in 90% equities. Do I buy bonds? That's unusual to be 3 years from retirement and 90% in equities, don't you think? Depending.
Everybody's different. This person probably has a little bit higher risk tolerance. Depending on everything else that's going on in the portfolio, reducing that may make sense. Just depends on the individual and, is 90% 900,000 or 90 million? It might not matter if it's the latter. But yeah, I mean, I see that a lot when I'm meeting with new clients, is they'll have, kind of getting back to Brian Perry's slide, where if you're not rebalancing over time, you wind up with a portfolio that's very equity heavy because equities have done well. The tax consequences of unwinding that can get pretty complicated. We do have a number of tools to help there, but that scenario where you get close to retirement, your equities have done amazing, and all of a sudden it's time to hang it up, and you're just taking on a lot more investment risk than you want, that's pretty common. We do have things that we can do to make the tax impact less than it would be otherwise. So, I mean, I hate to sound like a broken record, but just coming back to the idea of having a financial plan that's going to guide you on how to make these decisions over time, over the long haul, over market cycles, over how things are going to develop, is really where you need to start. And then the actual specifics of how you get there comes afterwards.
And I think that's a perfect segue, because we're just about out of time. That, there's a lot of pure clients on there today. If you'd like, if there's questions following this or whatever, so absolutely reach out to your financial advisor, talk to them, see what's going on, rerun your financial plan. If you're not a pure client, we do offer free financial assessments. Do something with this information. You took the time to come to this webinar. Do more research, talk to your financial professional if you don't have one or you want a second set of eyes. We offer a free financial assessment where you can sit down with a certified financial planner, take a deep dive into your portfolio, see what sort of risk you're taking, and if that is appropriate given your circumstances. They'll also review your tax return and give you thoughts on, are there any tax moves you should be making today, cash flow decisions, et cetera. No cost, no obligation, completely free. I know Catherine put up a link for that. So if you want to take advantage of that, again, it's completely free. We'll get you in as quickly as possible, despite the volatility. I think this is a great time to take a fresh set of eyes, have a look at your situation. If you're a pure client, reach out to your financial advisor, and thank you all for attending, and I'll kick it back to Catherine.
Thank you so much, Brian and Brian. It was an amazing 1 hour, went very quickly, but you had a lot of information. So we appreciate everyone who's been on this call, and we look forward to talking to some of you in the future.